Hello and welcome. My name is James Kelly. I'm the Head of Aviation Finance at KPMG. On behalf of KPMG and Airline Economics, I'm delighted to welcome Michael Inglese. Michael is the CEO of Aircastle, and he's joining us here in New York in October 2025 for the purposes of our Aviation Leaders Report. Mike, thanks for joining us.
Thank you. My pleasure. Happy to be here.
Maybe just before we get into it, Aircastle is a very well-known franchise in the market, but you want to give some of our viewers who may not be fully familiar with it a little bit of background on Aircastle.
Sure. So Aircastle is leading secondary player in the aircraft leasing space. We have about 275 aircraft owned and managed with 75 lessees in 45 countries around the world, about $8.5 billion worth of asset value. We are investment grade rated by all three major rating agencies at BBB flat with S&P, Baa2 with Moody's, and BBB plus with Fitch. And we are owned 75% by Marubeni Corporation and 25% by Mizuho Leasing, who took us private back in March of 2020.
Okay. If we might just start to the macro picture for a moment, be interested in your perspective on the demand environment, particularly on the airline side, and what you're seeing on a regional basis. Is it different in EMEA, the Americas aspect, or are you seeing trends emerge?
Sure. Overall, demand is very good still. I think we're running at about 5.5% RPK growth this year through August. We're regionally, I think the U.S. is reallocating and condensing capacity, particularly in the LCC segment, but elsewhere, seeing good traffic numbers, very high load factors basically throughout the world. Europe has been strong. Asia has been recovering. We still haven't seen the reemergence of the Chinese tourists yet, but other groups and people are flying. They're maybe not quite back to where they were pre-COVID. And then Latin America, where several airlines have gone through restructurings, traffic numbers are still very strong, and the people who've been through and have come out of restructurings are doing particularly well in that part of the world.
Okay. We've been through a period of maybe trade tension, geopolitical tension. Thankfully, we've reached a good answer on tariffs, but maybe there could be indirect consequences, whether it's on inflation, whether it's on the cost of aircraft. What's your sense on that geopolitical tension and the impact it's having on the aviation business?
I think it's somewhat muted. I think it's affected some traffic between Canada and the U.S. and Latin America and the U.S., I think, on a short-term basis. But as you mentioned, with the sort of resolution of the tariffs between Europe and the U.S., where the two big OEM airframers are, and the continuing exemption of aircraft parts, that resolved, I think, what was probably the biggest overhang in the early days back in the spring when the tariff regimes were first announced.
Okay. The OEMs, Mike, right, and their impact on the supply side, right? So we've had a difficult couple of years, probably a sense here in New York that things are starting to ease, or at least the OEMs from a quality and a reliability perspective are starting to improve, tentative steps maybe. Be interested in your sense on that, and then maybe the impact that's going to have in your business as maybe production rates ramp up over the next couple of years.
Sure. So I think what we've seen as the production levels have been trying to catch up is a lot of the big lessors who have big order books were not getting the sort of investment volumes from those order books that they typically did. So they were less inclined, and it put sort of pressure on how much trading activity took place in the secondary market, which we felt in the sort of the early days coming out of COVID. Levels have started to ramp back up, and I think we expect, as both OEMs work their way back to higher production levels, which they've both targeted, that we'll start to see more secondary market volume resulting from the order book lessors as that picks up.
Okay, and then maybe to flip to the engine side, there's been well-documented issues around engines, particularly newer technology engines. When you're looking at your portfolio, how do you think of that and how do you manage it?
Yeah, so look, we have a number of GTF customers in the A320, A321neo family. They're managing through it. Clearly, the effects of that on Spirit help compound their issues. Their Chapter 11 filing, they're rejecting essentially all the NEOs they have with powder metal issues on their GTFs. So that will affect everybody in terms of getting those assets back, getting them through a shop, and getting them redeployed back out in the marketplace over time.
And do you think you could have a short-term impact on the market, or can the market absorb it?
I think maybe the benefit of kind of the log jam at the engine shops is it's going to take time for these to flow through. So I think it'll help mitigate it's not like 100 very well maintained and ready to fly aircraft coming into the market in 1 week. It's going to take time, I think, for those to
more like a
become available and get back into the market over the next year or so.
Okay. If we just pivot for a moment to lease rate factors, right? So if you take a supply constraint, consumer demand haven't come right back, we've had a big improvement in lease rate factors. Where do you think they're going to go in 2026? And even to break that out across the different aircraft types that you guys own?
So it feels to us like lease rates have sort of peaked. And we're expecting rates to come down. They're maybe doing that a little slower than we were thinking 6 months ago, but it appears the U.S. Fed is on track for maybe 1 or 2 more rate cuts before the end of the calendar year, which should translate into some easing. We've benefited from an incredibly tight credit market in terms of spreads are at all-time lows, which is beneficial to people like us and our peers who are active in the U.S. Capital markets from a debt perspective. And that also translates into the pricing of ABS deals, the unsecured loans that people are doing as well in the marketplace.
Okay. You touched on the Spirit bankruptcy. I suppose in this sector there will always be some bankruptcies,
Correct.
Right? So any trends emerging that you're particularly concerned about, whether by geography or by a operator model?
Look, 4 or 5 years ago, everyone thought LCCs was a great model everywhere. It's clearly shown some of its weakness in the context of competing with the majors in the U.S. market, where there's pretty significantly large players with the capacity and the ability to sort of put capacity in competition directly with those folks that has caused problems for some of the U.S. LCCs. Elsewhere in the world, I think we still have some carriers in parts of the world where they didn't get any significant government support, or they didn't go through formal restructurings during COVID, who may have debt levels or repayment schemes under their COVID lease restructurings that may be challenging for them to deal with. So there may be some working out of those situations as we head through 2026. But by and large, I think many carriers have gotten their house in order. They're flying, very high load factors. It sounds like yields might be sort of topping out a bit. But I think by and large, airlines in our portfolio are in pretty good shape.
And do you think the market can carry that kind of hangover COVID debt and work it out?
Look, I think it'll take whether it's the actual lenders, whether it's lessors who participated in the support for some of those customers. My guess is people are going to find ways to continue to support customers where they believe that's the right answer.
I want to spend a little bit of time on trading. As you said, you're a very significant, one of the world's largest secondary traders, and buying and selling. I'd be interested in whether you're a net buyer or a seller in 2025, and then how competitive is that market? How do you look at value when you're both buying and selling aircraft?
So we've been sort of buying younger, new, and mid-aged prior tech and selling our older stuff over the last 2 to 3 years. In fiscal 24, we invested about $1.6 billion. We sold somewhere north of $600 million. You have like $400 million-ish of depreciation, so kind of net growth of, call it $600 million. And I would expect in this calendar, or this fiscal year, which ends for us in February, that we'd be doing similar volumes, maybe a little more selling, and perhaps a little bit more buying as well. But we continue to find opportunities for both investing and continue to be very active in the sales market.
Okay. If I flip from the asset side of the balance sheet to the liability side, and you're pretty much exclusively unsecured funded, and you've been out during the summer, both with bonds and earlier in the year with an unsecured facility. Start with the bonds, the strength of the bond market, and the depth of it. I'm interested in your perspective, And maybe if you could touch on as well the importance of your IG rating, which you mentioned earlier.
Yeah, look, our IG rating is kind of a fundamental tenet of our strategy, and having the flexibility and the efficiency of raising capital to pursue opportunities is very important to us. The investment grade market is incredibly deep. It's been very robust. I think the sector as a whole, investors have gotten educated over the last decade and have come to appreciate the resilience of the business model through COVID, through the Russian invasion. The rating agencies have, I think, taken a fresh look at it in light of those two black swan events and come to recognize the resilience of a good leasing platform is pretty remarkable, and that the depth of that market, as I said, gives you speed of execution and pretty good sense of certainty when you're launching a deal of how you think things are going to turn out. If you're trying to do a secured bank deal by comparison, you're talking a lot more work up front. You're talking a much longer deal gestation time, and so a lot of things can move away from you while you're pursuing that kind of transaction.
And the IG rating, how hard do you guys have to work to maintain that?
Well, look, you gotta, we took us a long time to get there. We started in the high yield market in 2010. We first got upgraded to BBB- levels with the agencies in 2018, and we just got upgraded to sort of the BBB flat section of the investment grade. So it's a hard journey. It's a key focus for us to make sure we maintain. I think we have a pretty good understanding of kind of what ratios, what debt levels, what kind of interest cover the agencies expect to maintain those ratings, and it's a focus of ours to make sure we preserve that.
Okay, and just flip to the bank market. What's your sense on the depth of that market? I suppose if you go back maybe 2 or 3 years, or 4 or 5 years, probably there was exits from the market, particularly in Europe. Maybe a contraction of the number of banks out there. It feels like it's become a bit more stable, and in fact, if anything, banks are coming back into the market. Be interested in what you're seeing when you're doing your revolvers.
Yeah, I think it's your characterization. I would agree with it. It's ebbed and flowed a bit over time. 3 or 4 years ago, it felt like some of the traditional European banks were getting a lot of pressure in the context of ESG about aviation and lending and other transportation assets, and so it felt like some of them were pulling back. Clearly, private credit has come in, and that's not only given more liquidity to the sector, but it's also, I think, spurred the competitive dynamic with banks to sort of make that come back and look to push more. Now that the ABS market is coming back very strongly, it helps people who did warehouses thinking they were going to get an ABS takeout, and then when that market sort of stalled, it created banks were in warehouses that they for much longer tenor than I think they thought when they put them in place. So it feels like that sort of tension has worked out, and the ABS market is used by many of the people we sell aircraft to, and in our view, generally more liquidity, even though it creates some more competition, is overall better for the whole sector.
Okay. If I flip to the equity side, obviously owned by 2 standout Japanese houses. Can you talk to us about being owned by a Japanese group and what that kind of equity expects, what kind of returns they're looking at? And then your perspective, Mike, kind of question we're asked across the board is, aviation as an asset class versus other assets that you can make an investment in, and I'm sure they do make investments in. I'd be interested in what you hear there.
Yeah, so look, they like our sector. They're not only invested in aircraft leasing and Aircastle, they have other investments in part-out companies, in used and serviceable material companies, and other aspects, engine leasing joint venture in Singapore. So I think they like the overall value chain and the demand outlook for aviation going forward. So they've been very supportive. As I said, they put new equity in post-COVID to help repair some of the damage that COVID did, but also to give us growth capital that we can leverage to grow our portfolio, try to restore our profitability to ROE levels that were more consistent with what we did pre-COVID, and that's what we're focused on in terms of thinking about organic growth and helping to drive a higher ROE. And then we'll also keep an eye on what's happening around us in the sector, because M&A has been more in the headlines recently, and we'll see how that plays out in the context of the shifting landscape of top 10, top 20 lessors.
Just on your M&A comment, even if you're not part of those M&A's deals, how do you think about those? Are you looking at maybe aircraft coming out of some of those transactions that could be interesting? Are you sort of thinking that there could be other opportunities emerging from them?
Yeah, and I think we've seen that in the past. If you take the recent SMBC Air Lease deal, I think most people believe the Air Lease portfolio will be in selling mode, probably at a greater level than it was as Air Lease itself. And so I think lots of people expect some of those assets to come to the market over the coming years. As you've seen other people, SMBC buying Goshawk, Carlisle buying AMCK, Avilease buying Standard Chartered. I think when people buy a company or a big portfolio, they typically find things that they really want to keep, and maybe other stuff, whether it's customer concentration issues or lease expiries, things that they probably want to bring to the market. So we've always seen opportunities coming out of former big portfolio trades or M&A deals.
Just a final question on M&A. Like, it's typically in kind of 1-2 transactions a year, give or take each year. Do you think that could accelerate, or is it just from a liquidity perspective it'll always be at that kind of level?
It's hard to say. I mean, I think most people are expecting a few medium, smaller sized companies to be in the market soon. We'll see if that in fact transpires and whether deals get done that make sense for the prospective sellers. But I think people who maybe have started platforms in the last 5 to 10 years and haven't really had the ability to scale up the way they were thinking when they started are probably the most likely people to find ways to either combine with or perhaps sell to larger players in the business.
Okay. If I think you said earlier, M&A is a small part of what you look at. Trading is a big part of your growth strategy. The other channels, sale and leaseback or purchase and leaseback.
Sure.
Is that something you guys look to participate? Are you involved in campaigns, or do you prefer to stand those out?
No, look, we've been reasonably successful in working on sale leaseback transactions, and it's been part of our strategy since pre-COVID to start to migrate our overall portfolio towards the new technology aircraft as the industry moves forward, as the supply chain issues get dealt with, as the engine issues get dealt with. The industry is going to migrate to NEOs and MAXs, and we wanted our portfolio to sort of move along with the market and move along with what customers clearly want to have. And well, unfortunately, all we've seen so far is very good fuel efficiency performance, not so good time on wing issues, and the costs are growing. So the overall economics of the new tech story have a lot of sorting out to do as we move forward. But we've been active in India with Indigo. We did some MAX 9s with United. We've done some MAX 8s with WestJet recently. We've done some work with Frontier, Volaris, Viva. So we typically run somewhere between 60-40 trading with other lessors and sale leasebacks, and that sourcing kind of fluctuates from year to year depending upon what's happening out there.
And how competitive are you finding it in those campaigns vis-a-vis even 2 years ago, say?
Look, they're still competitive, but clearly you look at people like Indigo and United, they have enormous CapEx programs that they're undergoing, both for fleet replacement as well as growth capacity. And they also have, their programs are so big, basically they need a lot of lessors, because lessors sort of get full up. And so you got to have a good Rolodex of people that you can bring in to help. And so for us, when we did work with Indigo, it was sort of well into their program. We weren't that competitive in the early days, but then as we watched the program develop and we found opportunities, our cost of capital changed and benefited us and gave us an opportunity to be a little bit more aggressive in those cases.
Mike, if I put it all together, right, so at the end of 2025, I'd be interested in your perspective on, one, how optimistic you are on the market going into 2026, and as CEO, what is the number of risks that you're most focused on?
So I'm good. I'm optimistic, cautiously optimistic. As we've learned with the new administration in the U.S. this year, things can change pretty quickly. But having the right team with experience, having a portfolio that's diversified across the world and across asset types helps you deal with the inevitable bankruptcies, restructurings, or things that happen with airlines in the world. Things I worry about, I think I touched on it a little earlier, still some more sort of COVID restructuring work for some of the industry to work through with a few different airlines. But I think my sense is we'll find a way forward, and we'll see how that plays out.
Okay. Well, with that, Mike, it just leaves it for me to thank you for your insights and continued success to you and Aircastle into 2026.
Thank you very much. Pleasure to be here.